Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, and of course one of the founding partners here of the Dividend Kings. Many of you know me as Mr. Valuation, and in that light, one of the things I like to think about, and I don't know if my colleagues all would agree with this, but I like to think of myself as kind of the valuation policeman for the Dividend Kings here. And so here as we start out 2021, we're into the third week of January or so. One of the things I think it's important is when we're looking ahead to what 2021 might bring, I think we ought to really take a hard look at valuation. There's an awful lot of talk about whether the markets are in bubble territory and whether the market's overvalued or not. And I'm going to try to bring some clarity to that discussion here with the graph that I'm showing right now on the S&P 500. I'll start with that. But then I'm also going to be taking a look at some dividend aristocrats, mostly, that are also trading at very high valuation. The theme was know when to hold them, know when to fold them, know when to walk away, know when to run. In the spirit of the Kenny Rogers song, The Gambler, which, many people approach investing as gambling, but I do believe investing can be done prudently and intelligently, and I believe all intelligent, prudent investing is fundamentally based on valuation. So what I want to do is give everyone a sense of what the market values look like. So let's start by looking at the S&P 500 here. And for those of you not familiar with my fast graph tool, the orange line plots the earnings per share at a PE ratio of 15. That's an earnings multiple of 15 times earnings, which is a historical normal multiple. The blue line represents a PE ratio of 18.6, which we call the normal PE ratio, which represents a valuation that the market has commonly applied. Now, these are valuation reference lines. You want to use these lines as analytical tools to evaluate what the value of the market looks like. Now, coming into the recession of 2001, I want you to notice that the market was very overvalued. The PE ratios back here were, in the 25 range. We're currently a blended PE of 27, I want you to notice. But this was a very high valuation for the market at that time. And then, of course, we saw the earnings drop during the recession, just like we did in the Great Recession. We saw earnings drop. The market was fully valued at that time, but not necessarily overvalued like it was in 2001. And of course, this led to an immediate 40% drop in the market over the next, from January of 2001 to September of 2002. So we'll call that a 21 month period of time. The market lost 40% of its value. And then the market kind of stayed at reasonable valuations till we had this dip. And then as the market came out of the Great Recession, the prices had reverted to the mean. It even got undervalued at the bottom of the market. But keep in mind, that was undervalued stock price in a period of time when the market's earnings were also dropping. That needs to be considered. But then the market got fairly valued, and it stayed within what I would call prudent and even attractive valuation ranges for the next 3 or 4 years. And then really starting, if you will, in August of 2013, we started to see the stock price separate. It got up into the upper levels of this 18 PE ratio here. And by the way, the market grew earnings at 5.84% over this time frame that's measured here, which is normal. 5, 6, 7, 8% growth, depending on the time frame you're measuring, is pretty normal for the markets. But then we've gone through this, raging bull market. So if you look at advancing stock prices, you can argue that the prices have advanced, going all the way back here to February of 2009 through yesterday's closing price. We've seen stock prices in just a raging bull market. But it didn't really get overvalued until it left this red line here. And then we started to see high valuation, but it still stayed reasonably within this high level of valuation, the PE ratio of 18, until we actually ironically came into COVID, okay, which was obviously, we all know those dates, so I won't bore you with them. But here we had, the market kind of peaking, where we had this really good run of stock prices, but then COVID came and the market collapsed. I want you to notice that earnings began to collapse, but inexplicably, since that period of time, since really the end of March 2020 or 2020, we've seen this almost parabolic advance in the markets again. The markets have gone up almost 46%. Now, by the way, for those of you who want to Google this, look at what stocks are dominating the market. This is primarily dominated with tech stocks, Google, Apple, Microsoft. Many of the real large tech stocks are dominating the valuation of the market. And I always say it's a market of stocks, not a stock market. But regardless, the overall market is very high. And as I'll show you here in a moment, most of the extremely high quality dividend growth stocks are also high. So part of the moral of the story here is, a lot of people believe in indexing and just invest in the market. Well, I believe this is a very, very bad time to be investing in the stock market. The risk of investing in the stock market at these levels over the next couple of years could be very, very, dangerous, leading to very poor results, even losses, because of the market's excessive valuation. All bubbles at some point must burst. But nevertheless, I think it's clear here from the evidence that the market is not trading at rational valuations. Valuations are very high, and I'll illustrate that even more when I get into individual selections. But the point I really want to make here is that we are in a very inflated market, and we should be aware of that, and we should be focusing. So the question is, we got to know when to hold them, know when to fold them, know when to walk away, know when to run, so to speak. So what I want to do is I want to go through a series of stocks here, and I'm going to do something I'm very excited about. I'm going to introduce the new beta version of Fast Graphs, which we're going to be launching hopefully a week from this coming Monday. And this is the new version of the tool. One of the things that I'm really pleased with and I'm really proud of is how quickly it loads graphs. And I wanted you to see that. So those of you who are subscribers to Fast Graphs, this is what you have to look forward to in the next several weeks, maybe month, when we actually launch it fully to everybody. But we will be launching it in beta on Monday to those who are beta testers for us. But I want you to take a look at some of these iconic, really well-known blue chip dividend growth stocks. We'll start with Clorox. It's A- rated. It's a dividend aristocrat. It's got 25 years of, increasing their dividend. You can see that this white line is the dividend. You can see that the dividends increased year after year after year. And this is one that I alluded to in the article as one you might want to walk away from, because you can see that it's been given a premium valuation by the market, many, many times, or very quite often over the years. But there are also times, and this was an extended period of time of a couple of years, where it actually traded down at that 15 PE ratio, which is what the orange line on this graph depicts. This company grew at 7.1%. The stock price got excessively high by July of 2020, and now we've actually seen a correction in the stock price, from the high of 236 to it's currently 197. So what's happening is, we're starting to see a period of time here where the valuation of Clorox is starting to drop. So if you're a long-term owner of Clorox and you're worried about protecting your principal, this would be a time that you might want to walk away, because here we have, a stock whose earnings growth is expected to flatten. It's actually expected to be negative, only modest. We'll call it break even in 2022. And this company has a June fiscal year, by the way. And then very little growth for 2023. And then only 2 and 3% growth going forward. So we've got growth rates significantly slowing down, and we've got very high valuation, which I consider a recipe for disaster. Now, one that I argued this is not an aristocrat, at one time was a dividend aristocrat, is General Electric. And this is the point I wanted to talk about here, about a stock that you went away from. Because what's happening here, first of all, we saw the stock come through the Great Recession with real good earnings growth. We see the risk of very high valuation that happened back in 2001. But then we saw this stock really see the earnings collapse in 2008 and 9. They slashed their dividend, of course, during that time frame. They cut it, virtually in half, and then dropped it again in 2010. Then they started raising the dividend again for a few years. And then we get out here into 2017, 2016, and we start to see earnings beginning to weaken again. And then we saw another massive dividend cut. Well, this is what you want to run away from, because here, this isn't about valuation. This is, about the deteriorating fundamentals, a business that's no longer possessing the attributes that, it was once known for, and you wanted to own General Electric because it had this steady growth and steady dividend increase. Those days are past. I believe you run away from that kind of scenario. Next, I'm going to go to VFC Corporation. Hope you're seeing the speed of the loading of these graphs. And here we end up with an interesting situation. The stock, corrected dramatically during, COVID, obviously. And then we've had continuous drop in stock prices. And this is Wrangler Jeans and so on. This is VFC Corporation, if you're not familiar with them, or Vanity Fair, it used to be called. And now we've had this run up in price, but yet what I really want to make a point is future earnings growth is expected to be very strong over the next couple of years. And this year, which ends in March, the fiscal year ends in March, so March of 2022, next year, March of 2022, they are expecting a recovery off of 2021, which was obviously a very bad year. Earnings fell by 50%. We're going to see that in a couple of months, whether that actually comes to pass or not, because that's still an estimate. But then we're expecting a recovery. But I want to make a point. This growth does not justify this valuation. So, you need to be aware of that. We saw high valuation on the stock back here in 2015, and we saw that led to a correction. I think we're in the similar situation again. McDonald's is another one that's been very popular. The stock, has done actually pretty well during COVID. Their earnings did weaken a little bit, but notice that the price is above any historical norm. Here we've got a normal PE of 19.3 with the blue line, and now we've got the current PE trading at 33 times earnings. And the reality of it is the company is expected to recover, but this earnings growth does not support the current valuation. Yes, interest rates are low. But unless interest rates are going to create a lot more cash flow, this company is not expected to generate the future cash flows to support the valuation that it's currently trading at. So this is one that I think you should probably walk away from. Apple, I talked about, these stocks are dominating. Look how Apple's stock price tracked its earnings here. And again, we're using a 15 PE ratio over this time frame. We've got earnings growth here that isn't calculable, so I'm going to shorten this graph a little bit to give you a little better perspective. Now I'm using a PEG ratio, PE ratio of 22, and Apple is still significantly overvalued. It's expected to give some decent growth going forward, but nothing to support the valuation that the stock currently trades at. As I like to say, valuation matters, and it matters a lot. Air Products and Chemicals, another great iconic, blue chip A-rated stock. You can see the price has tracked earnings all these years. Then all of a sudden now we get this connection. Now we are getting some accelerated growth here. We have historical growth of 8.6. If I shorten this time frame, we're expecting double that growth rate going out here on the forecast. But even then, when I bring price into the equation, the stock price is dramatically above what its earnings would justify. If I calculate performance out here, you can see that the stock is actually going to give us a very, very weak performance. Let me do one shorter because we still have a little buggy here. You're looking at negative rate of return if it goes back to its normal 15 times earnings going out there. There's risk when stocks, even as high quality stocks like Air Products and Chemicals, gets overvalued. This is another one you might want to walk away from. Sysco. Now Sysco is interesting because obviously this is a food service company, and the market has historically applied premium valuations to this stock. Of course, COVID came. It actually did suffer, 43% drop in earnings for the year ending June of 2020, followed by another 10% in 2021. And as you can see, the price has gotten way ahead of the earnings. There's no way that these fundamentals justify the company's current valuation. It's just, this doesn't really make any sense. So now let's move on. Let's go to the Standard & Poor's Global Inc., S&P Global Inc. itself. This is Standard & Poor's company, better known as. You can see the price correlated to earnings. You can see this very high valuation. And here you're seeing a situation where the market looks like it's already beginning to revert to the mean and get the stock to where it belongs. And I'm just going to go through a couple more quickly. Medtronic. Look at Medtronic. When we had this long, massive period of high valuation here, it ended up leading to a negative rate of return for more than a decade. It was high valuation. The stock did great. Now we once again have the price trading up here at a very high blended PE of 27. We have too low a dividend yield. We have weakening earnings due to COVID mostly. And yet here we have a stock that's trading at an excessively high valuation again. Valuation matters. Nike is one that's really inexplicable to me. This stock is trading at such an outlandish valuation that it just makes no sense. This is one that I think you would actually want to run away from. And I can go through many more. I'm going to kind of quit here. Illinois Tool Works, again, you see these high valuations. be aware of these high valuations and recognize that this is an inflated market and stock prices are not being supported. Regardless of low interest rates, they've created high demand for stocks, but they have not justified the value of stocks. At least that's my opinion. We take a look at Colgate here. Again, you see a stock that usually has a premium valuation. It's even above that, starting to revert to the mean. I usually talk about undervalued stocks and try to represent opportunities. Accenture is another classic example of a massively overvalued stock. So I thought it would be fun to show you and hopefully helpful to show you how overvalued some of these stocks really are. But in having said that, we also have plenty of stocks, and we've shown them in various features. Our other dividend kings have shown them. We've got names like Bristol Myers that are actually trading at low valuation. So it is a market of stocks, not a stock market. But be very careful with your valuations today because it's very hard to find good quality and attractive value. Hope you enjoyed this video. It's been my pleasure as always. We'll talk to you again next week. Thanks for watching. And if you like what you see here, don't forget to subscribe to my YouTube channel as well. Appreciate you all, and let's have a prosperous and happy and healthy new year coming up here. Thanks, everybody.